Welcome to the WebEx session on how to prepare for sale of technology company with DC advisory. The session will be presented by my colleagues Huzefa Tavawalla, Harshita Srivastava, Aishwarya H, Klaas Oskam of DC advisory. Please note that this session will be in listen-only mode and will last for about 60 minutes, of which first 30 to 40 minutes will be spent on panel discussion. The remaining time will be available for question and answers. Requesting all the participants to be on mute mode for the session. You can post your questions in the chat window while the panel discussion is on. The moderator will queue up the questions for the speakers accordingly. Should you need any assistance during the conference call, you can use the chat option. Do note that this conference is being recorded. I now welcome our session presenters, Huzefa Tavawalla. Huzefa has heads the Bangalore office of NDA and is also an avid techno-legal enthusiast. Harshita Srivastava, head of startups and VC investment practice. Aishwarya H, leader M&A practice. Klaas Oskam, managing director and India head, DC advisory with experience over 20 years and a focus on cross-border M&A and PE. Over to you, Huzefa, our moderator this evening.
Thank you. Thanks, Mamta. Good morning, good afternoon, good evening to all our participants who joined the webinar across the world. Much gratitude for joining virtually. I think this session could not be more topical, specifically considering how the industry has been evolving and which markets evolving. What is most important in the tech space is how do you actually prepare for sale of technology companies, right? Because the entire purpose is that deals have become more industry centric. There are more industry specific issues, not only from a general commercial law perspective, but even from a regulatory perspective, even from an IP perspective, even from a tax perspective, and so forth and so on. So no better way than to queue up this session. I think my co-panelists are experts in their own field. So we've got a regulatory, legal, and tax blend from NDA in-house, and of course we have Klaas, who heads DC advisory in India, who's going to give industry insights from a banking perspective. So, with that note, I think let's dive into this session. And I think to kick off the entire session from a sales side or from a seller's perspective, the most important thing upfront is to understand what are your business objectives, right? And once you know what are your business objectives, the important thing is what are the corresponding structures which are available to implement these objectives. On that note, it would be great if Aishwarya can throw some insights, on the same.
Thanks, Huzefa. So, as Huzefa mentioned, before we decide to sell a company, one of the most important objective is to realize the business objective that we want to undertake, by which we want to sell the company. So, the mode that we choose will have an implication on timing, legal and tax considerations, successor liability, employee transfer, and business continuity. Broadly, there are 4 modes of transfer of a company or sale of a company, being share sale, asset sale, business or slum sale, and court-approved processes such as mergers and demergers. I'll briefly give you an overview of all the modes and why one may choose one of the mode over the other. Beginning with a share sale. A share sale, as we all know, is a simpliciter sale of all or part of the shares of a company. While an asset sale is when certain specific assets and liabilities may be cherry-picked by the acquirer to be purchased, and when a separate value is attributed to each of these assets. Now, for example, taking the example of a tech company, where assets are largely customer contracts, IP, computers and laptops, leased property and employees, and the liabilities are, say, possibly a bank loan and employee liabilities. The user may choose that he wants to acquire the IP and move the employees to his entity and the related employee liabilities, and wants to leave out customer contracts and lease property and also the bank loan because he has his own lease property and customers. So as compared to a share sale, the benefit of an asset sale is in a share sale, the purchaser acquires the entire entity as a whole with all its assets and also inherent past liabilities. And he cannot do away with any past liabilities of the entity. But the difference between a share sale and an asset sale and the benefit that a share sale has over an asset sale is a share sale ensures continuity of business. That is, employees need not be moved separately. The purchaser need not obtain any specific business registrations or licenses, or need not ensure that business licenses are transferred. Then moving on to a slump sale, or also known as business sale. And why it's known as a business sale is because the entire unit or a business undertaking of the seller is transferred on a going concern basis to the purchaser to qualify as a slump sale. So what this means is that the acquirer, unlike in an asset sale, can't cherry pick the assets and liabilities he wants to purchase, but will need to buy the unit as a whole, such that when the unit, after being taken out from the seller entity, is able to carry on business without any external support on a standalone basis. It may be possible to structure slump sale and exclude certain liabilities and assets, but this will need to be checked on a case-to-case basis. For example, in the previous example where I gave, where the acquirer decides to pick only IP and move the employees, in a slump sale, it may not be sufficient to qualify as an undertaking. But of course, this is on a case-to-case basis. Then we have court-approved processes such as demergers and amalgamations, and which are laid down under the Indian Income Tax Act, and where the Act clearly lays down that in case of demergers or mergers, all assets and liabilities of the transferor entity needs to move to the transferee entity, and a certain number of shareholders of the transferor entity need to be given shares of the transferee entity. Of course, this is a court-approved process, or the National Company Law Tribunal approved process. And as compared to the other structures that I have mentioned, that is the asset sale, slump sale, and share purchase, is a little time-consuming because there's a third party involved, which is the court, and also may offer lesser flexibility as compared to the others. So while structuring a mode of sale, the seller has to keep in mind a lot of factors such as these. And also the other point is, now if the seller has, say, multiple business verticals in one entity, which is housed in one entity, and wants to sell only one vertical, then it may be better for the seller to undertake a business transfer and asset transfer so that he can retain his other business verticals in the same entity and continue the rest of his business. More importantly, there are also certain tax considerations for deciding the mode of transfer, which we will take up in the next session, which we'll take up shortly. Over to you, Huzefa.
No, I think, thanks, Aishwarya. I think these are the more popular modes which have been used, and, as you've rightly pointed it out, in the past, not pure play 100% M&A, but, there have been structures where royalty fees or fees for technical services have been also capitalized for equity, because actually that is permissible from an exchange control perspective under the automatic route for tech companies, since FD has allowed 100%, but of course certain pricing guidelines will need to be adhered to. In addition to that, share swaps, primary share swaps, can also be definitely considered. But what is more critical from a seller's perspective is what are the tax considerations. And probably before we go to Klaas, where he can give an overall industry insight, probably Harshita, it may be a good idea if you can just throw some light in terms of what are the key tax considerations in the business objectives or business structures which have been followed. Okay, I think there seems to be a lag with Harshita.
Can you hear me now? Sorry, I was on mute.
Yes.
Okay. Sorry, taking it from Aishwarya, where she described aptly the different modes of transfers which could be adopted basis the commercial considerations that the parties have in mind. I will quickly lay down the tax impact on of each of those transfers, each of those modes. Talking about one, the slum sale or the business transfer, where we are talking about transfer of one or more undertakings on a going concern basis without actually assigning individual value to the assets, and where the consideration is received by the seller company. The tax impact, on the seller company, going by the letter of the law, according to section, 50B of the Income Tax Act, if the business undertaking is held for more than 36 months, then the seller is going to be liable for a long-term capital gains tax at the rate of 20%. And if the undertaking is held for 36 months or less, then the seller will be liable for short-term capital gains tax at the rate of 30%. Now, once the cash is received by the company, it needs to be upstreamed to its shareholders, which can either be structured by way of dividend distribution, where the company will have to make a withholding of 10%, or buyback, where there is a tax on the company to the tune of 20%, or upon liquidation, where the reserves and surpluses of the company can be distributed, and there'll be different treatment for that. The other important point to note here is, and especially in tech companies, is that either the cost of acquisition would be very low, or it would be very high if the company has patents or other IP which is recorded in its books. Now, if the cost of acquisition of this IP and is very low, then going down the route of business transfers may not be very tax efficient for the seller, for obvious reasons, because the differential is going to be pretty high, in terms of the difference between the sale consideration and the cost of acquisition. The other benefit, of adopting a business transfer over an asset purchase, and before I move to the asset purchase taxable, taxability around on asset purchase, is that a business transfer is not liable to GST, because it's on a going concern basis, and a transfer of business is specifically excluded, as supply of goods and services under the Act. Moving over to the second option, which Aishwarya pointed out, which is asset sale, where we are cherry picking the assets as opposed to transfer of an undertaking. It has the same approach as the business transfer, where the seller company is receiving the consideration and the cash can be upstreamed to its shareholders by the three methods we just discussed. The difference here would lie in the fact that GST would become applicable in this case, and capital gains will be determined with respect to each asset separately, depending upon the holding period of each asset. So it'll be an exercise which the seller company will have to undertake, determine the holding period, and then decide on the taxability of each of them. Going to the share sale, which is simpler than both these two options, we know that the residents will be charged at the rate of 20% for long-term shares held for long term, and 30% for short term. In case of NRs, it will be 10% for long term and 40% for short term. Another interesting thing to note here would be, and especially in cases, if we assume a tech company scenario, let's assume that a tech company is based out of the US and which has multiple step down subsidiaries, and India is one of them. In that scenario, if let's say an NR shareholder of the US company sells shares of the US company to another NR, then by virtue of the provisions of the ITA as they stand today, which is the Income Tax Act, such non-resident shareholder will also be liable to be taxed in India, of course, subject to the treaty benefits available to it, if the US company is deriving substantial value from the assets in India. Now, there are tests and formula which have been laid down to determine what constitutes substantial value, and it can be determined on a case-to-case basis. But while doing such transactions, of indirect transfer, we need to be mindful of the tax liability that may accrue in India. Over to you, Huzefa.
No, excellent, Harshita. Just on the last, just to tie up the last point specifically on indirect transfers, the IT Act also has a small shareholder exemption, just for the benefit of all our participants, whereby if the transfer, even though the attribution of 50% and the value of assets, which is 10 crores, gets triggered, which is around $1.25 million. But if the holding of the NR in the Indian company is 5% and less, then there is an exemption on the applicability of the indirect transfer provisions. And lastly, from an asset sale perspective, actually depending on how do you structure it, an asset purchase may actually become beneficial from a seller's perspective too, because typically asset sale direct taxation is based upon block of assets. So if there are 5 assets which are belonging to a block of assets in the books, and just one asset is actually being sold off, the cost of acquisition, the base for computation is the entire block. So, as you rightly said, it would be a fact specific scenario. But of course, that is more from a legal, tax and regulatory perspective. What is more interesting is how does the industry view it, and who better than Klaas to kind of weigh in here and give insights on what sort of structures has he seen and key takeaways on the same.
Huzefa, thanks, and pleasure to be on the panel. I hope I'm audible.
Yes, Klaas.
Okay, perfect. So I think, globally we're a platform of 500 bankers doing 160 deals a year. In India, we're 25 bankers doing typically 8 to 10 deals a year, mostly in the tech sector. So this is what we see, and we are mostly middle market bankers. So most of what we do is $50 million and upwards, 50 to 500, occasionally larger. And there we definitely see that by and large, 90% plus of the transactions tend to be share sale transactions. And that's just, and we won't go into further detail, there was already quite a bit around it, but to avoid 2 layers of tax where, it gets first realized the sale consideration in a legal entity, and then from the legal entity, you have to upstream it. And just the ease of kind of being able to transfer the entire business in one go. So by and large, in the middle market transactions that we tend to be involved in, because of predominantly tax reasons and ease of transferring the entire operation, we see predominantly share transactions. And we also do know that a lot of buyers then subsequently merge that legal entity with their existing Indian legal entity to kind of get depreciable goodwill, so to make it for the buyer standpoint subsequently tax efficient. I think the one exception to the rule where we see some asset sales and acqui-hires is smaller transactions, and typically businesses which haven't really performed to the level that was expected, where the buyer is really acquiring a capability and a team of key people. And there, in certain cases, we've seen the acqui-hire work well. Key reason being because there, typically the majority of the consideration is really in the form of future equity grants, and those equity grants then typically get structured in the form of ESOP constructs. And those ESOP constructs from a Foreign Exchange Management Act of India provides for a fair bit of flexibility to actually tie people in and tie the key people who in a tech business are the most valuable resource to future employment and delivering to the needs of the combined entities subsequently. So in smaller deals where a part of a business gets acquired, or where a team is taken out of a business, and the upfront consideration is minimal, so the tax consequences are really not there when it comes to the upfront piece, but where you kind of want to give an equity grant to the key team members through ESOPs, there we do see acqui-hires. That's kind of, I would say, the 2 main structures, but as said, by and large, in anything sizable, $50 million plus, in I would say 95% of the cases, we see the share transaction being the prevalent mode of transfer.
No, thank you for these insights, Klaas. They're extremely valuable. And leaving from where you ended, you mentioned acqui-hire. I think in this particular vertical, which is technology, essentially there are 2 valuable assets when it comes to companies, right? One is the IP, the intellectual property, and the second is the people. I think so. It may be a good idea at this point in time to actually talk about the IP, and then actually we can move on to the acqui-hire, vertical on that. Now, when it comes to any deal, the buyer would always want to ensure 2 things when it comes to intellectual property, right? The fundamental is ownership, and second, which is related to ownership, is the chain of title in relation to ownership, which means that yes, you own it, but how good is your chain when it comes to from a bottom-top approach. Now, typically, the way Indian law looks at software, which is primarily a lot of focus in the tech space, is it is actually protected under the Copyright Act as a computer program. So software typically is granted protection under the Copyright Act. The patent is a separate discussion where, if it's coupled with the hardware, you can get a patent. But most of the object code, source codes are protected under the Copyright Act. Now, typically, unlike most developed countries, India specifically does not recognize the principles of work for hire. It's not expressly given, though in substance we do follow it. So what does it mean from an ownership perspective? A lot of R&D actually gets undertaken in India, by the target company, and that target company may undertake the R&D/development either through its employees or either through third-party consultants, or there is some co-developing arrangement which is undertaken. From a software perspective or from an IP in this space perspective, between an employer-employee relationship, automatically the employer becomes the owner of any IP, which is software in this case, which is developed by the employees. Having said that, that's not the case when it comes to third-party consultants or developers, whereby what the law says is that has to be an express assignment to perfect the title of the target company. And if the assignment is not perfected, the pitfalls are as follows, because there is a key nuance under the Indian Copyright Act, which essentially says if the assignment does not specify the term and territory, the rights are limited to the territory of India, and the term is only 5 years. So now, from an optics perspective, you can say, yes, the target company is owning the IP, but in essence, the IP rights are only limited to 5 years and the territory of India. Now that becomes a big no from an acquirer's perspective. So when you're preparing to sell a company, just ensure you actually dot the I's and cross the T's, specifically ensuring the chain of title is okay. The other common issue which comes here is also the use of open source, right? Now, a lot of companies have varying policies in terms of what to use and which open source to use. But when you're actually preparing yourself, you should also probably undertake open source diligence, like a vendor diligence on yourself, to understand what sort of open sources over a period have you signed up to, and how can it actually impact the monetizing of your product. And this will also tie in depending on what is your product offering. If it's a pure license or a licensed product, the schematics are completely different. But if it's a IaaS or a PaaS or a SaaS in terms of a service offering, there will be different nuances to the same, because the open source terms at times are quite draconian in some cases, where you actually need to share the source code. And it also actually restricts monetization, from a fee perspective. I think the third bit specifically, it's not so much of an issue, but we have seen companies actually err, while selling, is from a model perspective. A lot of foreign companies have R&D centers in India through subsidiaries, and they eventually actually sell out. They sell the foreign company and they sell the Indian companies, like a lock, stock, barrel sale. But when the R&D actually happens in India, the contractual relationship between the Indian R&D entity and the foreign parent, which is actually monetizing customers, the contractual arrangement is not great. So in spirit, the foreign company thinks that it owns all the IP and downwards it's licensing and servicing the IP, but at the back end, the assignment has not happened. So essentially, there could be a situation where the foreign company has signed up with multiple customers, multiple agreements, where it could have stated we own the IP and they've given representations, but it may not be true basis the fundamental principle which I just mentioned, that the assignment has to be express with specifications on term and territory. So this is these are some of the nuances which are very unique and akin to the tech space. But moving on to the other important vertical, which is absolutely an essential ingredient for tech companies, are the people. Now, a lot of deals essentially may not happen for the IP, but may happen for the people. And that was what Klaas mentioned, right? And actually hire. So at this point in time, it would be great if we can get some insights in terms of what are the nuances on acqui-hire from an industry and from an Indian regulatory perspective. And I'll probably ask my colleague Harshita to weigh in for the same.
Thanks, Huzefa. You rightly mentioned one of the most critical, I would say, aspects of business transfer deals is structuring the transfer of employees from the seller to the buyer. In fact, more and more transactions are now occurring because of the availability of well-trained, experienced, and talented resources who are readily available as part of the transaction, of course, at a premium being attached to them. While it is important for the buyer to understand the categorization of employees of the seller in terms of workmen and non-workmen, it is equally important from a purely HR perspective to to conduct a thorough HR diligence, I would say, of the seller entity, to understand what are the HR policies that are applicable to its employees, the terms and conditions of employment, the employee benefits available to its employees and various class of workers, etc. Now, an important thing to bear in mind here would be that the post-merger integration would assume great significance in such situations, especially in acqui-hire, where human resources form a very important and integral component of the business transfer. Now, as I just mentioned about, the law specifically talks about what happens in case of transfer of undertakings and what happens to the rights of the workman category of employees. So broadly, the law makes a differentiation between the category of employees between workmen and non-workmen. Largely, as to put it in layman terms, the blue collar and the white collar employees. Now, dealing with workmen first, as per Section 25 FF of the Industrial Disputes Act, if the employment of a workman is transferred from one entity to another, the parties are required to ensure that certain conditions are met. Now, the three conditions being: one, that the workman's service should remain uninterrupted as a result of such transfer. Second, the new terms and conditions of service which are applicable to the workman after the transfer should not be in any way less favorable than those which were applicable to him immediately before the transfer. And the third one being that for the purposes of calculating severance or retrenchment compensation, the workman's previous years of service with the seller entity should be recognized. So, if any of these conditions are not met, then, it would trigger the retrenchment provision under the Industrial Dispute Act, which would thereby mean that the seller entity will have to give notice and severance payment in compliance with the process laid down under law to all those workmen who are being retrenched and who are not being transferred as per the process of law here under. The second category, dealing with the second category, which is more flexible, which is the non-workman category. Though, why I say flexible, because, the law specifically does not talk about how do you transfer them or the conditions of transferring such employees. However, the way to go about is that there is no need to deviate from these above, the conditions that we just mentioned in terms of workmen. You should follow a uniform process throughout. The parties will also be required to comply with the employment contracts and any other HR policies in relation to the transfer of benefits such as leave accrual, gratuity, transfer of PF accounts, insurance coverage, etc. As part of the HR related considerations. There could also be some employees who are not required to be transferred as part of the business transfer, in which case their employment may need to be terminated. And again, the process of law in terms of termination or the process laid down under the contract of those employees will need to be complied with. Now, apart from the transfer of employees, which we just discussed, basis their categorization, the other preferred mode, usually, mostly from a buyer's standpoint, is resignation rehire, where employees from the seller entity are made to resign. And again, this would be a very case-specific, approach to take. And it would depend on the strength of employees and what their contracts say and what is the HR policy of the company prevailing at that time, policy of the seller company, I mean. And depending on that, the employees of the seller entity may resign and be rehired, or a fresh appointment may be offered to them with the buyer entity. This approach is preferred by the buyer primarily because there is no backlog of liabilities which the buyers want to assume in terms of employee benefits or leave accrual, gratuity benefits, etc. So the cycle ends with the seller, and a fresh cycle could be initiated with the buyer entity. So again, depending on how the situation is, the strength of the employees, the contract with which the seller entity has with the employees, the mode of transfer, or whether it will be a transfer under law or the transfer under contract or resignation rehire, could be adopted by the parties in the transaction.
No, thank you. Thank you, Harshita, for these insights. I think what also gets critical is understanding the vertical of the tech space. If it's like a BPO industry, the modes of transfer kind of differ. We have seen a lot of deals actually get structured as a hybrid from an acqui-hire perspective, whereby the previous years of services are recognized, but there is no final settlement of gratuity vis-a-vis, when the employee is moving, say, under a resignation rehire. The sole reason being that there is always a question which comes is if the gratuity is being settled by the seller, then what incentive do the employees have to move forward, because they just take the money and go. And that's quite common in the BPO industry. But having said that, there are various permutations, combinations. One approach, the hybrid approach, is where the buyer actually recognizes the years of service, because since gratuity is paid on the last drawn salary, it's beneficial for the employee to continue employee recognition with the buyer. And once the buyer recognizes, there is like a purchase consideration adjustment basis an actuarial report from a seller's perspective, or there is a true up which is made. But of course, this depends solely from a case-to-case basis. But moving forward, I think it would be really interesting if Klaas could share some practical experiences which he would have encountered, basis the deal advisory. So Klaas, it would be great if you could throw in some lights, basis your past experiences.
On the IP transfer, or more on how people deal with human capital? I can comment on both.
That would be great.
Okay, so I think on the IP transfer, obviously in a tech company, it's the heart of the business. It's a key focus area for diligence. We see with most big tech companies that they have their own in-house teams doing this, and that very important is their technology alignment. Are the platforms being used the same? What's the maturity of the DevOps, etc. So a lot of time does get spent there, and then of course source code review and IP ownership. How does the source code scan that most tech buyers will do to see if there's infection from open source or not? How does that tie that back to IP ownership and end user licensing agreements and the likes? So I think there our most experienced tech hires have a strong playbook there. I've seen it many times over, and have their own in-house methodologies on how to do the tech diligence, but also how to subsequently integrate it in their larger organization. The only thing that we do see in situations where it's in a house team, you do often get a question and a debate. What's the kind of cost of what we're paying for this acquisition, and how much would it cost us to kind of develop the same tech stack? In situations where it's really more of a business acquisition, and where clients and existing customer base, geographical reach also become important, that question typically doesn't prop up. But in situations where it's more pure IP that's getting acquired, and that the global buyer then wants to leverage on a global scale, that make or buy decision does become pivotal. And there, the tech diligence can create go no go. So that's kind of what we typically see on the IP side, a big area of focus. And if there is situations where there's not alignment in terms of technology platforms, or there is issues around open source, then definitely people will want to put safeguards in place and see how to deal with those and safeguard themselves. On the people front, I would say that's almost as much time is getting spent there, if not more, than on the IP side, because typically you also buy something with a roadmap that there's going to be continuous innovation. and that the team is going to hopefully contribute to the combined agenda of the two organizations going forward. And there, what we typically see is, and that's also to do with, and I don't want to go too deep, but if you buy an Indian business, the amount of deferred consideration is capped at 25% of total consideration. Secondly, doing a cross-border merger is a challenge. And so in most situations, we see share transactions, and those mostly for cash. Two Indian organizations can relatively easily go through a merger. It takes time, but say a US or European acquirer buying an Indian company and wanting to kind of issue shares in the process, do it through merger. That's typically requires regulatory approvals, which you're not sure might be forthcoming, delays things. So we typically see that people do spend a lot of time on that, and that they either use ESOP constructs or use certain forms of preferred stock and tracking stock to kind of create those equity incentives to the key team members to ensure that there is alignment and between the parties going forward, and to make sure that the key people that are coming along with the acquisition are incentivized and retained to ensure the future success of the organization. And as I said, we've typically seen that there is workarounds and to the fact that a straightforward merger, cross-border merger, might not be possible. Implementing those workarounds typically it does take about 4 weeks of structuring work and getting the right advice from a legal, tax, and financial standpoint on how to ensure that you achieve that alignment where those key employees have the right equity incentives and the right skin in the game to make the subsequent transaction a success. That's kind of what we've typically seen, Huzefa.
No, I think very, very relevant and pertinent comments, Klaas. I think let's tie up what you said, right? Specifically when it comes to the entire sale consideration. How do you kind of incentivize the people? How do you continue the motivation? But also the consideration aspects. On that note, it would actually be interesting if Aishwarya can throw some lights, specifically in terms of how is purchase consideration typically structured, and are there any nuances from an earn-out perspective? So over to you, Aishwarya.
Sure. Thank you, Huzefa. So as we mentioned, the purchase consideration can be structured. Either it be paid upfront or deferred or put in an escrow, or be structured as earnouts. And this is either as an incentive to the seller to undertake some actions, or it is to address the valuation mismatch between the value arrived at between the seller and the purchaser of the business or of the entity. Or the acquirer may also want to dip into the deferred consideration for an indemnity claim, making an indemnity claim. So before we get into the details of purchase consideration, deferring, and escrow, it is important to understand that there are certain regulatory restrictions under Indian law in case of transfer of shares from a resident to a non-resident and vice versa, where there is a floor or cap on the pricing that is paid. In addition, under Indian exchange control regulations, in case of transfer of shares between a non-resident to a resident and vice versa, only 25% of the purchase consideration can be deferred or can be settled through an escrow mechanism within a period of 18 months from the date of the share purchase agreement. So as against the closing of the transaction, where there may be some time between the signing of the share purchase agreement and the closing, the Indian law permits only 18 months from the date of signing the purchase agreement for the consideration to be deferred. There are no pricing restrictions for structuring the purchase consideration between a resident and resident and a non-resident and non-resident. So in this regard, it is also important to understand that pricing restrictions are largely in terms of share transfers. Since in case of a business transfer, a resident entity is used to purchase the undertaking, as a non-resident entity is not permitted to conduct business operations in India without having a place of business in India. So they will need to incorporate an entity before they undertake the business purchase or slump sale. So these pricing restrictions are largely seen in case of transactions between a resident and a non-resident. As I mentioned, price can be either deferred or can be put in an escrow. So now, when when the price is deferred, when the purchase consideration is deferred, one of the nuances is the taxation of the deferred consideration in the hands of the seller, and when should it be taxed? That is at the time of accrual or receipt of the consideration. So where the payment of the deferred consideration is purely conditional, that is, it will happen only if so and so conditions are met, then there can be a view that is taken that the entire purchase consideration need not be taxed upfront, and the deferred portion of the purchase consideration needs to be taxed only upon receipt, upon happening of that contingent event. But when there is an absolute transfer and the purchase consideration is only deferred, say for a certain period of time, then in such cases, it may be required that the entire purchase consideration is taxed at the time of accrual and not just when the deferred consideration is received. Then there is also earnouts. So earnouts, as Klaas was mentioning, is a way to incentivize the seller or the promoters of the seller entity, where they are retained with the management and they are required to achieve certain milestones in the entity. And so as a seller, it is very important that to clearly negotiate the terms of these earnouts, the roles and responsibility, and also to push for a staggered milestone to enhance the possibility of achieving the milestone and getting the consideration instead of a lump sum consideration. Also, since earnouts are linked to the employment, it is important to understand the grounds of termination in an employment agreement and to what extent the seller has a say in the management of the company post his exit, that is, post him selling the shares of the company, so that he can achieve these milestones that the purchasers expected him to achieve without any hindrances. So earnouts may be typically considered as salary and may be treated taxed accordingly. In addition to deferred consideration, escrow, and earnouts, the other issue is also working capital adjustments. So working capital is a capital that's required for the day-to-day expenses of the company. So since this is a moving figure, it may be not possible to arrive at the exact working capital on the date of the transfer, the date of the closing of the transfer. So on the date of closing of the transfer, an estimate will be agreed, and then within 60 to 90 days, the exact working capital will be calculated, which may result in the need to adjust the purchase consideration. However, considering that there are certain implications under Indian law, Indian regulatory law that I mentioned, which is in terms of the floor or cap on the pricing, the regulatory implications of such purchase consideration will also need to be analyzed and discussed further before it is captured in the agreement. How would you?
No, I think extremely relevant. I think one thing which typical promoters and from a sell side, from an earnout structure, a lot of focus is given in terms of the commercials on the earnout, but Aishwarya has rightly pointed out, the employment agreement gets even more critical in situations where the earnout is kind of a milestone based and linked to employment. It may so happen that it may not be linked to employment as well, where it is just based on company performance. But in cases where it is linked to employment and company performances, negotiating the employment agreement, I think gets even more critical. I think once we've arrived at the mechanics of consideration, what would also be interesting is to understand, are there any nuances specifically from a tech space which people need to be aware of from a closing perspective? Are there certain tricky condition precedents, or in general any certain conditions which kind of derail timelines? I think one common pitfall is the understanding of special economic zones and STPIs, which is software technology parks, and if the target company is operating from those zones, or if they have a particular unit in those zones. Because typically what tends to happen, specifically in terms of a business transfer or an asset purchase, because stock purchases are not so impacted, when the assets actually leaving these STPI/SEZ zones, there is the entire concept of bonding, debonding, which comes into play, because then you need to go and take specific regulatory approvals if you're physically moving any laptops, computers, servers, and other electronic assets. And actually, not only does that take some time, but it also has a commercial impact if because certain custom duties which need to be paid on this debonding. Now, what will also be very interesting is if the buyer already has a unit or a presence in another SEZ, and if the transfer is happening between an SEZ to a SEZ or from an SEZ to STPI, because in those cases, things are a little different and custom duties may not always be payable. So a lot will also depend upon the status of the buyer entity and where they are located, and more importantly, where are the assets of the seller which are located. Another very interesting point, which we have actually had a few deal experiences, is when a non-resident is actually buying Indian assets, and probably it could be Indian IP, whether that requires government approval or whether that is under the automatic route. Now, there is no specific restriction or green signal permission which actually allows this, but the view which has been taken over the years basis guidance from the RBI vis-a-vis the authorized dealers/banks is when IP per se is not capitalized in the books of accounts, then any consideration and transfer usually is under the automatic route. Having said that, if the IP is capitalized in the books of accounts, it could be a patent or whatever, where there is tangible capitalization, then it would be need to be looked at a little more closely, and you need to approach your AD bank depending upon the nature of the transfer. So these two situations are critical: understanding what is the nature of IP vis-a-vis your books if you're directly transferring it to the NR. And the third point, and then I think over to Klaas, is there have been a lot of instances and deals whereby historically India was also used as a dumping ground for electronics and electric assemblies and related products. So there are certain rules and regulations which came into place, which are essentially called the hazardous waste management transboundary rules, whereby if an Indian company have imported certain assets under certain government regulations, there were certain end-use restrictions in relation to those assets. Specifically, for example, those assets could only have been used for R&D purposes, or they have been given an import license because they have been used in a particular free trade zone. So when these sort of assets are being transferred to the buyer who's going to monetize it for customers, or who's going to use it for internal business consumption purposes, it is important to also understand whether there are any restrictions or import conditions linked to those assets. So these sort of things may again not completely derail the deal, but may actually extend the timelines, because approvals maybe need to be undertaken, in this case through the Ministry of Environment and Forest. So these are the few nuances which are very unique specifically to the tech space and tech verticals, depending on which vertical do you fall in. But let's move forward, and I'll hand it over to Klaas. That how does he see the industry unfolding, specifically considering the COVID-19 transition which we all are going through. Klaas, any thoughts on the future?
Sure. I think immediately next 6 months from what for a long time in tech was a seller's market will move to a buyer's market. In times of uncertainty, M&A activity and fundraise activity comes to a halt because M&A and fundraising, it's confidence business, and it requires a lot of confidence from any party, investor or a buyer to pull the trigger. So in our view, the next 6 months we'll see a significant drop in activity levels. A lot of the M&A that might still happen will be much more bilateral in nature. And so because it becomes a buyer's market, buyer will have more time to assess, is this the right fit? And you will see less kind of tight auction processes. Also because businesses that can run an auction well are typically businesses that are doing well, and in a lot of situations, sellers will say, "Look, this is not the right time for me to monetize my asset. There's so much uncertainty, and a whole bunch of my likely buyers are themselves kind of focused on keeping their own business on track." And keeping their house in order. So net next 6 months, significantly lower deal activity, and buyers will have kind of more time and more likely be able to have bilateral discussions. And depending on how quickly, and that's difficult to predict, things start to bounce back from the current crisis. We do expect that probably by the end of this year, activity levels will start to pick up again, and that you then also start to see again more classical processes where a process is built around potential interest from a buyer, but there's others to tap into as well, and we'll expect more normal behavior to happen. I think the other one to keep in mind is that what we always see is valuations in the public market immediately correct. Every day we can see what happens to the stock exchanges on account of the turmoil. In private markets, that typically has a time lag, which is another reason why in private markets activity levels in the next 6 months will be lower, because it will take time before people will accept the new realities. So net, I think definitely significantly reduced activity in the next 6-9 months. Most of it going to be bilateral in nature, but I think the longer term, taking a more longer term view, we actually do see this as actually potentially a positive to the tech industry, because a lot of processes which are still part online, part digital, part offline, are now accelerated completely digital. And by and large, if you look at the level of impact of this on industries, then you can also see that a lot of the tech stocks have corrected far less than more cyclical and physical in nature, auto, logistics, you name it, other functions and sectors. So net, if we take kind of more of a 18 to 24 month type of view, then we believe that this entire episode will actually accelerate digital transformation and will further strengthen a lot of the tech companies out there, especially tech companies which are more kind of addressing horizontal requirements, areas such as DevOps. Obviously, if you're a travel tech company, then the impact is going to be more long term. So even in tech, it will be subsector specific, but by and large, whether it's SaaS, whether it's edtech, we do believe that if you take an 18 to 24 month view, that this is only going to drive more cloud adoption, and that it's not just the immediate beneficiaries of the likes of a Zoom that will benefit, but that the broader tech industry as a whole will come out of this stronger, and with that we'll see strong rebound in tech M&A activities in 18 months from now.
Absolutely. I think that's a great way to conclude, Klaas, by saying that we will see a strong rebound, and I'm sure we will go through these testing times stronger, and the industry will also come out stronger. I think on that note, we would like to kind of conclude this session. Thank you, all our participants, Klaas, Aishwarya, Harshita, and I think over to the Q&A. Over to you, Mamta. I think there is a Q&A, a question posed by Shobit. Probably I can take a crack at answering it. He's saying that other than restructuring, through a demerger / through court processes, is there any way to kind of carve out businesses whereby the proceeds directly go to shareholders? So Shobit, actually it depends on in terms of what do you want to carve out. I remember, a few years back we had done a deal. It was a pure, resident situation sort of a thing, whereby there was some amount of technology which was actually owned by the company. And what was actually done was that technology was actually transferred in the name of the promoter. It was transferred back to the promoter, of course, subject to board approvals, shareholders approvals, certain tax considerations which we'll need to factor. So it was scooped out of the company, transferred to the individual name, and then subsequently sold, and the consideration was directly received in the hands of the shareholder. Mamta, I think you want to just follow up on the Q&A with the audience.
Sure. Thank you, Huzefa, Harshita, Aishwarya, and Mr. Oskam for a very insightful and educative discussion today. Our next session will be held today evening at 9 p.m. IST on future of OTT regulations. Tomorrow afternoon, we have a session at 3 p.m. on e-mobility, discussing a sustainable automotive future, followed by session at 6 p.m. IST on iRobot, legal issues that will shape robotics. Lastly, session at 9 p.m. IST on IT issues in digital media. Stay tuned for interesting sessions every day. You can register on our website or through LinkedIn. Thank you for joining us, and you may now disconnect your lines.
I think just before we disconnect, if any of our participants want to write to us, feel free. The chat box is there, but otherwise feel free to write to us, and the panelists will suitably respond.